Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a different aspect from the investment landscape and attempt to bring the value approach as laid down by the man widely considered to be its founding father, Benjamin Graham, to the problem at hand. In this edition, we'll be looking at one of investment's most fascinating features. That is the concept of compound interest. We will consider exactly what it is, how it works in practice, and why it's so vitally important to any investor in the pursuit of wealth generation. So without further ado, let's get right on down to it. As ever, sit back, buckle up, and get ready to take on board another lesson in value investment as inspired by Benjamin Graham. Albert Einstein once famously called compound interest the eighth wonder of the world, labelling it as the greatest mathematical discovery of all time. He said of it, "He who understands earns it, he who doesn't pays it." This belief has also been echoed over the years by many successful investors, including perhaps the most famous one of them all, Warren Buffett. In fact, so important is compound interest viewed by Buffett in creating wealth over the long term. He has cited it as being in the top three things that he credits to his own success, along with good health and being born in America. So what is this magical force that has managed to get our best and brightest so infused? Compound interest is, in actual fact, an extraordinarily simple principle. It doesn't require calculators or massive IQs, and it can be understood by virtually anyone. It boils down to this very simple idea. In investment, the passage of time is very good at making numbers exponentially larger. For instance, if we start with $1,000 today, and each year that $1,000 grows by 10%, then the next year we'll be left with $1,100. Providing we leave the interest we've earned where it is, then the next year we'll earn a 10% return not only on the original $1,000, but also on the additional $100. If we were to simply forget about our investment and let this carry on year after year, then after 5 years, the pot will have grown to around $1,600. After 10 years, to around $2,600, and after 20, to around $6,700. And this is compound interest in action. And don't forget that $1,000 sitting in some piggy bank at home after 20 years will still be worth exactly the same. Buffett has a nice little way of describing the effect of compound interest. He likens it to a snowball rolling down a hill, getting bigger and bigger in size as it does so. Its small size at first means only a little bit of loose snow will attach itself to the main body, but then quite quickly the ball gets bigger and bigger, and before you know it, that little palm-sized ball becomes big enough to knock a person off their feet. We have seen that even with a relatively modest return of 10% interest per year, compounded over the long term, can pretty quickly grow small numbers into large amounts. And the larger the annual rate of compound interest, the more amplified this outcome becomes. For instance, it is widely considered that since Buffett took control of his investment vehicle, Berkshire Hathaway, way back in 1965, his annual returns have been in the region of 20%. If this level of return were to be transposed onto the same $1,000 as before, then after 20 years, instead of ending up with $6,700, as we did with the 10% annual rate of return, we would instead be left with a whopping amount in excess of $38,000. And this is one of the main factors why today Berkshire Hathaway currently has a market capitalisation of over $1 trillion, largely to do with the power of compound interest. Buffett has of course profited massively from the eighth wonder of the world too, although after donating an estimated $55 billion of his wealth to various philanthropic causes, he himself is down to his last $165 billion, according to Forbes, and is presumably feeling a little bit broke. Perhaps what is so extraordinary about the act of compounding is that it requires no effort at all from the investor. Buffett and all the other great investors out there do not have a monopoly on the concept. It is something that is open and available to every investor out there, and it's something that happens all by itself, just like with gravity driving that snowball down the hill. In fact, all compounding requires from the investor is that they put themselves into the position to reap the benefits from it. Compounding, just as with gravity, is quite a weak force, and there are unfortunately things that the great body of investors insist on doing that prevents the snowball's progress in its tracks. Number one is a propensity to want to trade shares in the markets. The thing is, every time you buy or sell a share, the broker will of course take a cut of their own. And so investors who do not hang on to their shares for the long term are going to see those fees quickly mount up. And so every one of those trades is like throwing a little bit of metaphorical salt onto that snowball. Only by keeping trading down to an absolute minimum can the act of compounding do its thing. Likewise, investors who cash out their profits as and when they arise will stop compounding in its tracks. If instead of letting that investment pot grow from 1,000 to 1,100, then that $100 is withdrawn to buy a nice new pair of sneakers, then compounding's best efforts will come to naught. If the investor can refrain from these impulses, then they should be onto a good thing. For even a quite ordinary investor, with the help of compounding, can achieve extraordinary results over the long term. There might not be that many people who can achieve the long-term results of someone like Buffett, but Buffett-esque rates of return are not required for compound interest to get on with its merry job. Even modest rates of return, coupled with a long-term investment horizon, can lead to huge wealth creation, if only an investor is able to sit on their hands for long enough. So by naming this podcast Compound Interest, the eighth wonder of the world, I'm not just doing that thing that podcast hosts like to do by coming up with a provocative subtitle. I mean it, compound interest really is that important when it comes to wealth creation, and the only person who can derail it from doing what it does so naturally is the investor themselves. As Benjamin Graham once put it, the investor's chief problem and his worst enemy is likely to be himself. The fact that the power of compounding is not broadly understood by most investors is a shame. It perhaps comes down to the fact that humans have evolved to equate effort with success. In virtually every other arena you can think of, as effort increases, so does the favourability of the outcomes. But investment oftentimes rewards inaction and prizes passivity and non-intervention. Until investors come to accept this paradoxical, even counterintuitive reality, then they will continue only to enrich their broker. It can all be summarised in one line by another great investor. John Bogle deftly put it like this: "Time is your friend, impulse is your enemy. Take advantage of compound interest and don't be captivated by the siren song of the markets." And my friends, ladies and gentlemen, it really isn't any more difficult than that. In investment, less is more. Remember that fact and you'll do okay. On that, I will draw today's podcast to a close. I do hope you've enjoyed it, and the concept of compound interest can become one more piece of the jigsaw in becoming a better value investor. As ever, please do consider adding to playlist. That way you'll be alerted whenever a new edition lands. And do continue to spread the word. That way we can make this as large of a community of like-minded investors as is possible. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.